A Starbucks leaves that location. Who do I get there filled in? That takes months to years. What makes a good triple net investment?
The biggest thing is the credit worthiness of the tenant as well as their business plan. Because you could look at companies like Forever 21's always in the media about having more businesses shut down and more stores shut down. That's not necessarily the most credit worthy tenant, although to the naked eye, they might seem like it's a credible tenant because they have locations all over the country.
I have never invested in triple net property. A lot of the properties are single tenant properties where it's the KFC or it's a Starbucks, right? Mm-hmm. And then they have a 15, 20, 25 year lease. Well, a lot can change over 15, 20, 25 years in terms like, hey, this business was great. Well, now they're the Pizza Huts and Pizza Huts are all gone. And my biggest thing with triple nets is it's either 100% or it's 0%. And like I was gonna think, hey, how can I mitigate the downside? And 0% on a property like that always seemed like a big risk to me because it's not a house. Okay, great. My tenant leaves. So like, oh, a Starbucks leaves that location. Who do I get there filled in? That takes months to years, I would think. What's up, Denver? Chris Lopez here, the host of the Denver Real Estate Investing Podcast. And today I got Kayla Mahoney in the studio to talk about triple net investments. We're going to go through about what they are, and actually go through about the pros and cons, the risk profiles of them, and actually go through what type of structures and what type of submarkets are working here in Denver. Kayla, good to have you in the studio.
Hi, Chris. Thanks for having me again. Happy to be here.
Yeah, so let's start into it. First off, Let's start with the basics. What is a triple net?
Okay. So first off, that's a great question because not a lot of people know that. Triple net leases are actually leases where the tenant is responsible for all the expenses affiliated with the property. It is structured in a base rent with triple net expenses. So the base rent is typically what you would be paying for the rent. The triple net expenses are the property taxes, the insurance, and the building maintenance, and they are a separate charge but are still included in your rent and are allocated on a pro rata share. So that basically means if you have a 5-tenant retail center at 10,000 square feet, each tenant is responsible for 20% of the value of the property taxes, the insurance, and any maintenance done on the building.
So I know a lot of people are attracted to them, and I first looked into it years ago because, hey, I don't have to worry about unexpected spikes in expenses. Mm-hmm. I also don't have to worry about building maintenance and all this because the tenant takes care of everything. And so it sounds very hands-off and very passive. Mm-hmm. That's the correct way that a lot of people look at it, right?
I think that that's how triple net leases are advertised, yes. And a lot of newer investors don't necessarily know this, but a lot of larger tenants actually lease out their spaces in order to acquire the tax benefits of a lease. If you look at like Walgreens, Panera, Starbucks, those are all tenants that actually utilize triple net leases. So they actually don't own the real estate and it works better for their business model.
What's the tax advantage on their side for having a triple net lease?
The tax advantage on their side is they can write off the lease as a business expense typically. That said, I'm
like
not
100% of it, I guess?
I'm not a CPA, so I'm not going to answer that question. But for the majority, yes. Yeah,
okay.
It is typically, but I always say to talk to your CPA about the tax benefits in full, but you can typically write off the value of the lease as your taxes.
Interesting. Okay. Now, obviously, most of the people in this podcast, they're not corporations looking for a lease. They're people who are looking to have a building, have some real estate, and lease that. Like, what makes a good triple net investment?
A good triple net investment, the biggest thing is the credit worthiness of the tenant, as well as their business plan. So if you're looking at any corporate tenant, I always suggest to go on Moody's and just see how their business is performing and what they're projected to perform. Because you could look at companies like, I don't know, Forever 21's always in the media about having more businesses shut down and more stores shut down. That's not necessarily the most credit-worthy tenant, although to the naked eye, they might seem like it's a credible tenant because they have locations all over the country. So it's really knowing the nuances within that corporation in order to structure the lease. But as a landlord, it could be really cool to say, yeah, I own that building and the building just so happens to be a natural grocer's or, it could be a KFC. KFC's not doing so well with the oversaturation of chicken concepts, but that's a whole other topic we could get into.
Well, I think it's an important thing to talk about because, I have never invested in triple net property. And like a lot of people, I looked at it, got out my area of specialty, but where I just got hung up on was a lot of the properties are single tenant properties where it's the KFC or it's a Starbucks, right? And then they have a 15, 20, 25 year lease. Well, a lot can change over 15, 20, 25 years in terms like, hey, this business was great. Well, now they're the Pizza Huts and Pizza Huts are all gone. And my fear, like my biggest thing with triple nets is it's either 100% or it's 0%. And like I was gonna think, hey, how can I mitigate the downside? And 0% on a property like that always seemed like a big risk to me because it's not a house. Okay, great. My tenant leaves. Takes me 30, 45 days to do a tenant in there. Like, oh, a Starbucks leaves that location. Who do I get there to fill it in? That takes months to years, I would think.
Yep. And you've nailed that on the head, Chris. The reason why we're talking about triple net leases is because I have a couple clients who are house hackers and, they're just tired of dealing with the daily stresses of having tenants, managing their own properties, dealing with the expenses affiliated with house maintenance. But a lot of these investors don't necessarily realize like, hey, if your tenant vacates the property, you have to be able to service the debt until you find a new tenant to place it. And typically businesses require such a specific build out for their company franchise wise that you would end up having to reconfigure that entire building. And most tenants, when they're leasing in commercial spaces due to the duration of their leases, typically expect an allowance coming from a tenant improvement allowance or rent abatement, and you have to be able to service the debt and handle the capex affiliated with portion or all of their build out in order to have a triple net lease that breathes.
So what type of I got so many questions on you now. So like I'm very curious for the landlords you're talking about, are they self-managing the property right now?
It really depends on what landlord and whose portfolio I'm talking about. I do have a client that does manage his entire portfolio, but he actually structures it as full service leases as well because triple nets tend to fluctuate. And he's like, look, I would be $1 or $2 above market rents, knowing that my property taxes are going to fluctuate. But when they fluctuate on behalf of the tenant, if it's not a strong tenant that understands the nuances of property taxes and how your rates don't necessarily go up 3 to 5% annually upon lease renewal, but will go up according to your property tax rate.
Yeah.
They kind of they're like, well, at least in that position, he's like, I would rather pay $1 more and not have my tenants vacate when they're shocked at a 25% rent increase because my property taxes increased 25%. Okay.
So for these current landlords, what type of triple nets are they looking at in terms of like, what's the spectrum of like kind of like minimum type, investment? And then, what type of opportunities exist now in Denver for triple nets? Because like, I'm really curious, like the submarkets within Denver and what type of, businesses and trends make sense now.
So right now, a lot of people who are investing with me are looking for multi-tenant triple net leases in order to mitigate the risk. Because if you have a 20,000 square foot space and it has 10 units at 2,000 square feet each, it's much easier to service your debt at an 80% occupancy versus if your Starbucks goes dark and you're sitting at 0% occupancy and you're still paying for that debt.
What about, I get this I guess I got two parts to this diversification question. Then, so you got diversification of multiple tenants.
Yep.
And then, great. If you, there's plenty of strip malls I drive by from my home to the office every day where they are about empty, right? They're probably 67% vacant and the big anchor tenants are gone from there. A couple small ones are in there. Like, I don't think those properties are doing very well right now. Is retail the hot thing? Is industrial? Is like what makes sense right now within triple net?
I think what makes sense right now for triple net in the Denver market is industrial and retail, but it has to be the right type of retail and it has to be in the right submarket and it has to be activated through curating the tenants properly and making sure that they are credible tenants. One example within Denver that I like on the retail side is what's happening in 9th in Colorado and how those spaces were fully leased out because the activation on that was absolutely beautiful. I mean, there's a movie theater, kids cooking classes, chiropractic. It's all amenities that are walkable to complement the condos in that community. So it really creates a beautiful neighborhood. Another space for activation that I like that's successful within the retail space is what Eden's does in Rhino. So Edens owns a good amount of Rhino. And as a lot of people know, like younger people go out in Rhino to have a great time,
Yeah.
and they've really done a great job with activating their 5 blocks. They do, even though they do have a turnover within their tenants, they've made that market truly desirable for businesses to migrate into, that it's easier for them to find tenants to lease those spaces.
So when you look at like Northern Colorado and Rhino and things like that, like what cap rates do those properties trade? I imagine they would be compressed compared to other ones because those are very desirable areas.
Yep. So the areas that are more desirable will be compressed. I've been seeing anything between a 5 and a 7 cap in those markets. 7 being a screaming deal. You're not going to find that in like Cherry Creek, but you might find a 7 cap in Glendale that's just adjacent to Cherry Creek. That's still a pretty popular area due to the fact that it's a mile away from Cherry Creek. A lot of the time, though, I tend to tell people to try to go for that value add component when you're looking at triple net investments, if you're able to stomach the fact that you're going to be potentially holding a vacant building for 8 months to a year.
So what is a value add play on there? Because I think of triple nets, I think of turnkey, I think of like passive. I do not think of triple nets as value add. Like, what does that mean?
I see a lot of triple nets where the tenants kept renewing their leases and they're significantly below market rents.
Okay.
So then you can say, hey, if you don't have another option to renew your lease, we can end up vacating this unit and then putting it on the market for slightly below market value. But because there's that spread between what they're currently paying and what you're about to receive, you can still generate a higher profit on it in order to make your return more advantageous.
So really the value add is just by increasing rent. Is that the main way you add value in triple net lease?
I'd say that's the main way, is just ensuring that your tenants are fully leased out, ensuring that the tenants are creditable, and making sure that their rents are at or slightly below market rents. The reason why I say slightly below is because, with these triple net leases, if a tenant has 5 years and they decide not to exercise their option because they find a space that's a little cheaper down the road, they're going to end up moving to that space to save money, because what's happened in Denver is property taxes have increased substantially. So even though your rents are increasing, since the property taxes have increased, it still might be more expensive for them to absorb.
So I know we're recording this in July, so property taxes went up. I'm
Yep.
sure a lot of landlords went out there and contested them. Do you have any data on how much a lot of these triple net buildings taxes went up? And are there any success stories of people getting their taxes reduced?
So I would actually refer that to an attorney I know named Kendra Sterling. She's absolutely fantastic. She does litigation for property taxes. For data offhand, I have heard property taxes going up 2-fold, specifically on Santa Fe. I was talking to a building
increasing 2x.
Mm-hmm. I was talking to
in the arts district, or what part
in
of
the
Santa
arts
Fe?
district.
Okay.
Yes. I was talking to a property owner there, and she might have to actually let go of her building because her lease is set up as a full service lease, but her property taxes went through the roof, and it was unexpected to her that she can't even afford to cover them.
Wow, that's brutal.
Yeah.
And I guess they've got the comps to go out there and justify it, and there's no way to it's not, hey, a lot of taxes went up, and now we've seen them come down some because of, the way prices spiked up and came down, but they just went up 2x, and it kind of is what it is.
Yeah. And, each case is different. Every address is different when it comes to your property taxes, but they have increased substantially in Denver, mostly because we have our local politics is mostly blue, and, to increase taxation, it provides them more money for government spending, which is needed. And that's just a cycle. But as a property owner, you do have the right to challenge your property tax increases every year, and I highly suggest doing so.
Yeah. So how does a landlord mitigate the risk of taxes jumping up so much? Or is it kind of what you said earlier with a colleague who, hey, they just increase rents but higher, but absorb the taxes? To me, that seems, I realize, hey, the tenants are on the line for it, but if the tenants can't afford it, that still affects me. So it indirectly raises my rent, right? Hey, if they're paying 2x in taxes, that's less rent they can pay me, or I can charge in that place. So as a landlord, how do you evaluate that risk, and how do you mitigate that risk?
So how you evaluate that risk is you just have to make sure that there's enough of a spread within your profits to potentially absorb those costs if the tenant's not able to be there. That said, though, this is really the big risk of triple net leasing. I have people who want to get out of doing the day-to-day maintenance, but ultimately it might be better to do the day-to-day maintenance on your multifamily asset because at least you're always going to have tenants there. And yes, you might have a higher turnover rate with annual lease renewals, but there is ultimately more stability in that. And really the best risk mitigation to do is just sitting on a capital stack and bank on that appreciation.
So what about, I'm going to change the questions here because I've had, for whatever reason, a couple different brokers and people. O'Reilly Auto Parts is a name I've heard numerous times the last couple of years in triple net. And I haven't looked, but one of them said, oh, they got a great Moody's rating, all that. And I mean, I go into an O'Reilly's or one of the auto parts companies like 3 times you to grab something. There's no one in there. And I'm like, how do companies like this, how do they continue to survive against Amazon? And when I go in there, they're like dead. And I go in there buy like a $5 thing because like Amazon can't give me for a few days. So I'm in there for buying something that's incredibly inexpensive. I have a hard time seeing like the macro trends on there. Like, I don't know if you got thoughts on like them specifically or like stores like that in general. But like, to me, I walk in there, I'm like, I would be terrified if I was a landlord of this property right now.
Yeah, I would be terrified too. I'm not a genie, but I do see within 5 years Amazon taking over, having more convenience within shipping, and ultimately there being more safety with investing in industrial. And that's exactly the point of this podcast too, is to discuss these risks because people think, oh, triple net, hands off, I'm just going to get mailbox money. And it's like, if it works right, yes, you will get mailbox money, but there are risks within the future that, we just don't necessarily know the future of shopping right now that, hey, even though this is a credible tenant now, would it be in 5 years? I'm not a genie, but I'm going to say probably not. So that's why with triple net leasing, it is nice to maybe find a company that, if you have to repurpose it, it's something that's highly desirable within zoning uses. Example, Take 5 Oil. They do primarily ground leases and their build outs. If a Take 5 Oil shuts down, finding a place for auto repair that's zoned for auto is so difficult that you will be able to lease that out easier versus if it's just a vanilla shell or a typical retailer.
So, okay, random question here. So for like that example here, who's responsible for any environmental issues? Because I bring it up because I had a friend, he was doing a deal next to an auto repair shop. And the auto repair shop, over the 6 years, they, oil and gas, whatever, leaked in the ground. And there was, a lot of issues around that. So like, as a landlord, if you own the property, are you ultimately responsible for anything that leaks from the auto repair shop into the ground?
Environmental, yes. Because with a triple net lease, the tenant is only responsible for the building itself.
Not the ground.
Yes.
So how do you mitigate that risk then?
I mean, I would just keep it to the same use,
Okay.
Really, like, environmentals only come up if you're planning to change the purpose of the space, or if it does trade hands, you do have to get an environmental just to understand the risk. But if you're keeping it as the same use and the same service, it doesn't usually have a big flag on
Okay,
it.
that makes sense.
Yeah.
So you're saying a great strategy out here is, hey, get into types of properties or industries that have a moat around them, so to speak, where, hey, they stay highly desirable, and then they're also just hard for people to go out there and find that type of that zone property.
Yep. And that's exactly why, I think I would go for more fast food places as well because they have the restaurant infrastructure in it. And finding a second-gen restaurant is extremely hard.
What's a second-gen restaurant?
A second-gen restaurant is a restaurant that was open and then shut down, but it still has all the furniture, fixings, equipments, as well as a grease trap and a hood vent. And it's that build out itself usually costs $250,000 to $500,000 depending on the scope that you want to do. And there's a lot of restaurateurs that want to operate as a restaurant, but they can't afford to do that build out. So they're easier to lease out.
Because you already have the infrastructure, the equipment in there, and then that will just carry over next tenant.
Exactly.
I've heard that having, I guess, a drive-through is very important for restaurants.
Yeah. Yeah, so QSR, which is just quick service essentially, is very much in vogue right now, and that goes back to reducing your real estate footprint. A lot of these a lot of these restaurant concepts know that people are on the move, they're grab and go. So the new concepts and the new franchises reflect that grab and go mentality, and those are the ones that need spaces. And having a drive-through on it provides that accessibility and convenience. That said, if you do have a drive-through space, I always recommend doing a retail analysis before deciding what type of tenant goes there. We'll bring it back to Starbucks because everybody goes to Starbucks in the morning. You wake up to get your morning coffee. You want to make sure that Starbucks is on the street that's going towards the highway traffic to bang a right, because that inconvenience of hitting a left on a multi-lane thing will deter tenants from actually going out of their way in order to utilize that service. And that's the same with dinner concepts as well. So like if you're in a dinner concept, you want to make sure that you're going the flow of traffic when they're going back to their house.
Interesting. I never thought about that, but yeah. Makes a lot of sense.
Yeah.
I can think about there's a Starbucks next to my house, and it's on the right-hand side going into Denver, into where all the traffic is.
Yep.
So how would you take Starbucks, right? So you look at them. I mean, they are a huge brand. I know they've gone through some challenges the last couple of years. Like, how would you evaluate like a Starbucks type, tenant and lease?
So I would look at the last 2 years of financials as a franchisor. I would also look at the Moody's rating and any public information I can get on Starbucks. I would try to see how many stores that they've opened in the last 2-3 years and how many stores that they've closed in the last 2 to 3 years. And then I would structure the leases instead of they typically like to do a 20-year lease, and Starbucks specifically is a longer term lease. But if there is a way to do a 5-year lease with options that provides you security as well, because if year 4 they decide not to renew their option, or if year 4 something goes weary, you have a year of them still being a tenant where you at least know, hey, I'm not renewing my lease. I can put this on the market for a year. And then once they vacate, you'll be able to have a tenant lined up easier because you spent a year marketing the space for lease.
How is that better than like a 20-year lease? I assume a 20-year lease, you got 20 years locked down. Or is it more so, hey, they don't give you that 1 year heads up, they're not going to stay there, they go out of business and they stop paying rent? Like, why is a shorter term lease better than a longer term lease?
So it really depends on the motive of the owner, and it really depends on the motive of the investor. I usually like having options in place as well, because as we've discussed, 20 years is a very long time and the world changes in 20 years. And if you're doing a 20-year lease with 3% increases every year, you're not reaching the CPI. So you're actually at the end of year 20, if they decide to renew that lease and you have the same rent increases, that ultimately ends up being at a rent below market value. So by having renewals in place, it'll allow you to bump up your rents in order to have it hit more market value if you want a stabilized asset. But that's exactly what I was talking about with the retail value add. So then when you go to offload your asset and you're at a 20-year lease and you're working with Starbucks and they're on year 15 and they've only been paying 3% annual increases, they're severely below the market rents because of how money appreciates.
Do people or do landlords ever structure, hey, maybe not a 3% annual rent increase, but pay it off a CPI or some other benchmark and increases based off of like a third-party benchmark?
Yep, I've seen third-party benchmarks, and I've also seen, a gross lease with a rev share for newer companies as well, to say, hey, you can pay $20 a square foot a year, but I'm also going to take 10% of your top line.
Wow. Okay.
And I mean, that's egregious. That's a very extreme number. I was just using.
That's not common.
No, but I was using just whole numbers for reference. Yeah, but a certain percentage off the top line as well.
Okay. All right. So what other parts of Denver do you like? You mentioned Rhino. You mentioned 9th and Colorado. What other submarkets in Denver and Denver Metro do you like?
I really like Bellevue. I like the Southlands and Aurora. But nowadays, since there's so many corporate tenants already there, the leases are extremely expensive. They're like $40 to $50 base rent, triple net. And so then you're looking at like $60 to $70 a square foot.
Is that a month or annual?
Annual.
Okay.
Annual. Yes. We should actually talk about how to calculate a triple net lease.
Yeah, go for it.
So when you see a triple net lease online, it essentially will show you typically the rent as a year. So if by us saying $20 a square foot, that's $20 a year plus the triple nets. And the triple nets are actually calculated on an annual basis too. So if you see, $20 a square foot with $15 triple net, you're looking at $35 a square foot a year. So now take that, and it's 1,000 square feet. Multiply 1,000 by 35. That's $35,000, and then you divide that by 12.
So it's just under $3,000 a month then.
Yep, you're looking at just under $3,000 a month all in.
Okay, that's very helpful. All right, so we are getting towards the end of this episode. What other nuggets on triple net should listeners and investors potentially know?
So triple net leases are typically leases that are for retail and industrial. Even though we've highlighted retail here, the reason why I highlighted retail was because the tenants have more of a name that has notoriety versus in the industrial space. But in Denver Metro, industrial leasing is a hot commodity. Everybody wants industrial. Everybody wants to be in Denver. It's a huge hub with DIA. I personally think that Denver industrial is a much more safe investment as a whole if you understand it. But the biggest thing is just pay attention. Pay attention to what tenants you have in place if you decide to go for a triple net lease. Try to acquire as much research as you can on them beforehand, and make sure that you are sitting on a good stack of capital for the risk mitigation, because that's really the only risk mitigation that you get in triple net. And yes, it is mailbox money, but it's mailbox money at a risk, and you have to be ready to equip for that risk.
Do you know, what's the average, industrial triple net cap rate versus the average retail triple net cap rate?
Yeah, so retail cap rates, it's all according to the submarkets. The more desirable submarkets are between that 5 to 6. The ones that are a little more on the outskirts, we're seeing 7 to 9, depending on the value that's added, depending on the vacancy rates. That can be structured on pro forma, which is sometimes upsetting too. For industrial, it is a little more compressed in the Denver market just because it's highly sought after. So I'm seeing anything between, a 5 to a 7 return on that.
Wow. Okay. The only little bit I know about industrial is a company I know, and they're a national company. They specialize in industrial triple net leases, but they focus on a lot of companies where a private equity group buys a company, and a lot of times it's an owner-operator. They own the business. They own the real estate as well. The new private equity firm buys both, but then they liquidate. They want to sell the building for capital inflow to go out there and reinvest in there. And then they specialize in buying the building and then putting in, a 20 or 25-year lease back on there. Mm-hmm. Is that a trend that you see around Denver, or is that a trend that's, common around the country?
That's a trend I see for larger institutional money, yes, is doing that sale lease back. Because a lot of the times you do need to, depending on the company's financial needs, it does make more sense to liquidate it, but they also do still need the real estate, so they will lease it back from you. If you do buy a business that is owned by, if you buy a piece of real estate that's owned by the business, ask them why they're selling, because that lease back can actually provide you a lot of security to service your debt, and you're helping them out by liquidating it, so they're able to get that capital injection they need to help their business grow. Yeah,
that's this group's thesis is hey, we know the company, they have a track record, they've been there for 20, 30, 40, 50 years. We get their financial statements, we're able to go through into their EBITDA and everything like that. I'm not invested with them, but the thesis makes a lot of sense to me.
Totally.
But I just, I've not dabbled in triple nets yet.
Yep. And I think that triple net investments are a great way to go. And, if somebody who is a multifamily investor who is looking to do a 1031 wants to explore this option, it is something that you should explore, but you have to understand there's a lot of risks involved. And yes, you're not dealing with the day-to-day headache of being a landlord and fixing a water boiler or fixing this, but you're going to have a good amount of capital in order to service the debt if a tenant's business shuts down. And typically when it comes to corporate tenants, their legal teams are much stronger than yours, so they will figure out a way to get out of that lease.
That's a good point.
Yes.
Kayla, if people want to get in touch with you, talk about looking at triple net investments, what's the best way for people to get in touch with you?
The best way to get in touch with me is through my email, Kayla.Mahoney, Kayla.Mahoney @evrealestate.com, like electric vehicle. You can also reach out to me at LinkedIn. I run the commercial division for Engel Volkers in Denver, and thank you so much for having me.
Cool. Thank you. And we'll put the links down in the show notes as well. But Kayla, another great episode. Looking forward to having you back in the near future.
Awesome. Thank you, Chris. I am as well.
All right. Bye, everyone. We'll
Bye,
see you on
guys.
the next episode.
Have a great day.